This is the Advanced Forex Course for Smart Traders 2.0. It's Lesson 10, Part 1, Writing and Testing Your Rules-Based Trading Plan, and my name's Sam Eder. Hey guys, in this lesson I'm going to take you through filling out the trading plan template. So what's important for you to understand about this is it's a process. So here you write your initial set of rules, you want to keep them relatively simple, and then later in the course, in Lesson 12, we're going to go through a method of refining and improving your rules. So this is just the start here. This is the trading plan template you're going to be filling out. If you don't have it, you can get it from the email that accompanies this lesson, or the written version of this lesson, or you can download it from our resource pack. And there's a link to that below this video. The first part to fill out is pretty self-explanatory. We just put our name, we put the name for our trading system, we can give it a cool name if we like, and then a short summary of what we're looking to do. So what's important here is you're focusing on one idea for the system. If you've got other ideas for trading strategies, that's fine. Just put them aside, put them on the shelf for now, and then later you can come back to them and build separate trading systems for them. So just keep this simple and focus on one idea here. In this section, you want to describe the trading opportunity that you see in the market. So just write this down here in clear language. And later, when we write down our market analysis rules, you'll note down exactly how you're going to define this opportunity when you go to trade it. For a rules-based plan, the opportunity you're looking to define is something that happens over and over again in the market. You want to follow a repeatable process. So for example, you could be looking to trade breakouts on the London Open, and you'll spend your time just mastering this one opportunity. And that's actually all you're going to need to achieve your goals. Next, I want you to note down how much trading capital you're going to allocate to the system. And just realize being properly capitalized is one of the keys to staying in the game. So from my time working for brokers, one of the main reasons I'd see traders fail is they would have too small accounts and they'd use too much leverage. So their trading account will stand normal market fluctuations, taking losses, or periods where their trading strategy doesn't work so well. So make sure you allocate enough trading capital here to make sure that the long-term edge of your trading strategy can be fully realized. Next, you're going to note down the instruments that you're going to include in your trading strategy. So for example, maybe you want to trade gold, or you want to trade Euro USD or USD Japanese yen. My tip for that section is you only need one good trade a week, month, or year, depending on your strategy's time frame, in order to achieve your goals. So many traders overestimate how many markets they need in order to get the results they want. But it's typically better to keep it limited, focus on one or two markets. Now, every trader is different. Some traders might have a strategy that relies on trading a large number of different instruments. Totally fine. That's cool. But my advice here is keep it as simple as possible. And just remember the trading strategy example from this course. One trade a day, one market generates 3% a month returns. Next, you're going to write down what market types this trading system is designed for. And again, just keep it simple. Ideally, each strategy is only going to work in one or two market types. So maybe it works in bull and bear normal market types, or maybe it works in sideways quiet market types. And if you've got strategies for different market types, then you would do a separate plan for those. But again, just keep it simple, just focus on one for now. Here you're going to write down the objectives that you came up with in Lesson 4. And just remember, because you haven't traded your trading strategy at this point, these objectives serve as the target performance for your strategy. They're what you're designing your trading strategy to achieve. In the position sizing section, you write down your 1R risk for the trade. You write down if you're going to trade larger on high conviction trades. And typically you won't do that for now, just keep it simple. And then you'll write down if you're going to trade smaller when you're trading on your core capital. That's the original trading capital that you put into your trading account. And I highly recommend that when you first start trading the trading strategy, you have a smaller position size. And then once you're profitable and you're in the money, you can then increase your position size to your full size. And this just serves to protect your trading capital. With your position size, just remember that how much you trade is going to determine whether your strategy meets its objectives. So you want to make sure your position size and your objectives are tightly aligned. Next, you're going to write down your market analysis rules. So these rules serve to clearly define the opportunity that you're looking to trade with this trading strategy. And remember, they should help you to identify conditions where you have a low risk, high reward trading opportunity. Next, you're going to write down the entry. So remember, the market analysis rules define the conditions. So you wait until you see these conditions. And then when you get these conditions, you wait patiently for your entry trigger. So your entry trigger should always be very simple. So list here when exactly you will enter the trade, and this could be a market entry, a limit entry, or a stop entry. And also note if you plan to scale into the trade. Again, typically you want to keep this simple, avoid scaling in, but there is certain strategies that rely on scaling in, and there is certain occasions where that is the right choice for your trading strategy. Next, you're going to put down your exit rules. So remember, your exit rules can be a little bit more complex than your entry rules. This is because different things happen after you trade, and you want to give yourself different ways to capture profits. But typically, you'll break these down into three main parts. One is your targets. The second is having a rule for if market conditions become overbought or oversold. So if you're in profit and you see overbought and oversold conditions and the market starts to turn, typically that's a good time to take profit. And then you want to have a trailing stop. And the trailing stop serves two parts. That is to protect profits on the trade, and also if you want to leave a small part of the position to run on the trailing stop. And occasionally that's going to give you very big wins, like a 20R plus winner on the trade. So just remember with your exits, one of the main goals is to let your profits run. So when you're writing your rules, make sure you're thinking about how you can have much bigger winning trades than losing trades. Next, you want to account for rules around news. So there's a couple of things to consider here. You might have rules that avoid entries leading up to news, during news events, or after news. So you can think about that part for your strategy. And you might also have rules for how you manage existing positions leading up to news events. So for example, you might decide you're going to close out prior to the event or close out part of a position, or you might decide you're going to leave a part of the position on or all of the position on. Then you might have a specific exit rule if the event really moves in your favor, how you're going to handle that. News events are going to be one of your greatest sources of profits or losses for your trading system. So when you initially write your rules, I'd advise you to keep it very simple, and then you can later update them based on the live performance of your trading strategy. So you'll get a feel for how often news are going to generate results for you, how often it's better to close out early, whether you should avoid placing trades over news because of slippage, things like that. So you can later define these rules, but when you first start, keep it very simple. Finally, you have some additional risk management rules that you want to include in your trading strategy. And these are really important because they help protect you from certain circumstances. So for example, here we have a rule that limits the number of trades we're going to take over a certain time period, and this protects us from overtrading. You'll note what you want to do when you hit the drawdown level for a time period. Typically that will be stopping trading, but there might be points along the way where you want to reduce your position size. So you can include that rule here. Next, you'll note what you're going to do if you hit your daily, weekly, or monthly targets. So are you going to continue to trade? Are you going to trade smaller? Maybe you get more aggressive. So this will depend on objectives and on personal taste. Next, you want to note down what to do if you're not able to follow your trading rules. Typically, this might be because of a psychological reason or because your trading strategy is a little bit overcomplicated and difficult to follow. So here, the idea normally would be to stop trading for a period, assess what's going wrong, and add in some new processes or reduce the complexity of your rules or work on your psychology. One of the reasons why having these risk management rules is so important is by knowing that your risk is limited, it gives you the confidence to go out there and take risk. So for example, I know that I can lose no more than 3% a month. So this gives me the confidence to go out there and execute my trading plan. So it's important that you have these rules in your trading strategy. So take some time to think about what you want to include here, because it's going to help you when it comes to actually executing and performing well in your trading strategy. I'll be back soon in part 2 of this lesson, where I'm going to show you how to backtest your trading plan with no code or anything like that required. And this will give you a good idea about how your trading strategy is going to perform before you trade it live. I'll see you then.